central bank announcements tells you where the macroeconomic action is going to be in the week ahead. On Wednesday the 14th of December, we have the US Federal Reserve. And then on Thursday the 15th, the Swiss National Bank, the European Central Bank, and the Bank of England. In all cases, markets will be looking at the degree of the interest rate increase, the amount of quantitative tightening or QT, as central banks try to sterilise the quantitative easing stimulus or QE that they pumped into the economies on and off since 2009, and it's generally been more on than off. And then finally, markets will look for any clues on the trajectory of interest rates and monetary policy in 2023. Financial markets are currently expecting a slowdown in the rate of increases, leading to a pause and a peak in interest rates in the first half of 2023, with the first rate cuts coming maybe in late 23, early 24. It's this narrative of pause and then pivot which has done so much to help share and bond prices rally around the globe since early October and also weaken the US dollar. So, really quickly, the US Federal Reserve is expected to raise by half a percentage point to 4.5% to end a run of 3/4 point rate hikes. QT is still seen running at $95 billion a month as it's been since September. The European Central Bank is also seen raising by half a point to 2.5%, slower than the 3/4 point increases at its last meetings. The ECB has so far fudged the issue of QT, but President Christine Lagarde has suggested it will outline its plans at this December meeting. The Swiss National Bank's also seen raising by 0.5%, this time to just 1%. It's also been selling down its holdings of global equities as part of its QT programme, and data from regulatory filings in the US and the Federal Reserve show that the SNB's balance sheet has so far shrunk by around 1/4 from its peak. And last but not least comes the Bank of England. The Monetary Policy Committee is expected to provide the fourth half-point increase of the week to 3.5% and keep QT at a run rate of £80 billion a year. There's still a smattering of corporate news due out in the coming week before things start to go really quiet into the festive break, although there is nothing on the schedule so far from FTSE 100 firms. The small and mid-caps, which may be worthy of a look and further research, include the following for what they say about themselves, their industry, or their economy, although do bear in mind that these dates could yet be subject to change. Chemring, Superdry and Begbie's Trainer on Tuesday the 13th of December, TUI and S3 on the 14th, RWS and Baltic Classifieds on the 15th, and Hollywood Bowl on Friday the 16th. However, the company which could just cause the biggest fuss in the week ahead is Currys. The retailer is due to release its first half results for the 6 months at the end of October on Thursday the 15th of December. As you might expect, given surging inflation, the cost of living crisis and fears of a recession, the shares have struggled over the past 12 months and they've actually fallen by some 40%. And that's despite a big rally since the autumn lows. We all know Currys from the UK's high streets and shopping parks, but Britain and Ireland represents just over half of group sales. Another 40% comes from the Nordic region, with the remaining 5% coming from Greece. So when it comes to these interim results, the first thing that analysts will look for is the trend in like-for-like sales by region. Now in the year to April 2022, Greece was up 4% like-for-like, the Nordics were down 2%, and the UK and Ireland were tail-end Charlies, down 4% year-on-year like-for-like. Then analysts will look at profitability by region. In the full year to April, the Nordic countries were the biggest earner, followed by the UK and then Greece in terms of adjusted operating profit. They'll note that the overall group operating margin was a pretty skinny 3.5%, to show what a cutthroat and competitive business it is selling electricals, white goods and mobile phones. Last year in the first half, by the way, Currys generated £4.8 billion in sales and turned that into a stated operating profit of £95 million and an adjusted one of £91 million. Attention will then switch to the balance sheet. At the end of April, Currys had £126 million in cash, £82 million in borrowings, so far so good, but it then had a £257 million pension deficit and £1.2 billion in lease liabilities on its stores, for a total net debt position of £1.5 billion. With a skinny operating margin, that's not entirely comfortable, although interest cover was 2.3 times last year and net debt was more than 2.5 billion 3 years ago, so it has been coming down. Study of the balance sheet and cash flow will then lead to a look at the interim dividend. This was 1 pence a year ago, and Currys also launched a £75 million share buyback at the same time, on its way to a total dividend for the year of 3.15p a share. Consensus seems to be looking for an unchanged payout in fiscal 2023, but one analyst is actually looking for a cut to zero, so we'll see. Finally, analysts and shareholders will look to Chief Executive Alex Baldock for an update on the guidance he gave for the whole year alongside the full year results back in July, since when, by the way, the company said exactly nothing, although some of its Nordic peers have produced some pretty poor numbers. The key points of Mr. Baldock's guidance for the full year to April 2023 were as follows. Adjusted pre-tax income of between 130 and 150 million pounds, down from 186 million last year. Capital investment of between 140 and 160 million pounds, slightly up on the year, and also positive free cash flow. While Mr. Baldock and the board have an aspiration to increase the dividend and return any further surplus cash to investors via buybacks, once the investment has been made, do remember, of course, that the buyback has been put on hold after completion of that prior programme. I hope that you and your families are keeping well. Thank you for watching, and I look forward to seeing you next time.